New data released from the Federal Reserve Bank of New York shows that U.S. household debt balances are on the rise, and so are late payments. Everwise Credit Union Area Manager Adam Young is here with some advice on managing your debt. Good morning. Thank you for being here.
Hannah, I'm happy to be here with you.
So, first and foremost, where do people start? How can they start handling this?
I think the first thing to do when it really comes to your debt is understanding exactly where you are to know where you're going. And debt really is just on the expense side of your balance sheet. So really understanding where all of your kind of income and expenses go. When you think about income and expenses and net worth, debt lies in the expenses. So the first thing to step as far as getting to know where your debt is knowing exactly where all your expenses lie. And
then maybe focusing on the cash, is that an aspect of it?
At the end of the day, you have a limited amount of income that you have come into your bank account on any given month, and you know exactly how much expenses come out. Debt falls into those expenses. You've got a lot of needs, you've got a lot of things that have to be covered on a monthly basis, but typically things that you may have borrowed money from, which is the debt aspect, lines up and you have a minimum required payment. So knowing exactly where all your cash flow is on a monthly basis is most important.
There are kinds of debt. So what are the two big kinds of debt that we're talking about?
When you really look at debt, you have two different options. You've got a fixed rate option, which you kind of think of with your mortgage or your car payment, and then you've also got a variable rate debt, and this is typically like more the variable rate, meaning that the interest rate can change, and this will line more in your credit card debt, sometimes in a home equity line of credit, but it can change a little bit, but sometimes can offer a little bit of flexibility when it comes to how much money you have going out on any given month.
I think sometimes we hear one is worse than the other, like maybe it's okay to have a mortgage versus maybe credit card debt isn't as wanted as much.
I think that most people, when they're thinking about their debt, they think about good debt or what's okay debt, and a mortgage definitely lands in that arena because it falls within the needs that you have as an individual. When you think about credit card debt, those are typically things that you want to buy and you may not need exactly, and it comes with maybe a little bit higher rate of interest, so some may look at that as being not as good a debt to have.
This can be daunting. So what are the strategies to try to, I don't know, chip away at it? How can we even start that?
When you're really looking at your whole cash flow environment and you're looking away, how can I really chip away? You're really focusing on the needs, and you really kind of look and say, all right, once I meet all of those needs and I have a little bit extra at the end of any given month, you want to use that extra to maybe make decisions on the things that you've already done and pay down the debt that you've already made decisions on. You can use an approach called the debt snowball approach, where you stack up all of the different items that you owe money on, and you take the one that you owe the least amount on, and you take all the extra cash flow that you have and you apply it toward that debt while just maintaining the minimum required payments on all the other debts. Once that debt's eliminated, then you go back and you say, all right, I'm going to go and hit the next one that has the most money that I owe on it. And you kind of keep a snowball approach to that debt, and it ultimately gets to that last item and you're debt free at that point. And that's the most exciting moment for people.
So you start with that smallest amount that you owe because you actually have a better chance of not, I guess, growing the interest amount that you owe?
The reason for that is, honestly, each one of those payments have a minimum required payment, and once you eliminate one of those, it really elevates the amount of money that you have to go and make to the next one. So it just allows for this snowball approach to paying down that debt as fast as you can. And ultimately, although debt is needed to get things that people need, most people look at it in a negative way and they want to get it taken care of as fast as possible. And this is just an approach to get that done in the most efficient way.
Any final words of wisdom to anyone watching who's maybe like, oh, that's just too much, I can't even start? What would you say to them?
I would say that most people have debt, and at the end of the day, we use debt in the world to kind of get things that we need, oftentimes in the mortgage or the car, or maybe we have that unexpected expense that comes up. So it's not uncommon to have debt, but the way that you can approach it with the cash flow and just having an understanding of where you are to know where you're going is the most important thing. And really, there's a lot of different strategies, and not all are equal, but you can do it if you have your mindset to get it done.
Great advice, Adam. Thank you so much.
Thanks,
we appreciate it.